Okay, welcome to the deep dive. Today we're tackling a topic that, let's be honest, might sound a little bit, well, dry, annuities,
Mm-hmm.
but actually, according to the stack of source material you sent our way, including a really sharp deep dive from the Making Money Podcast YouTube channel, featuring an expert from a UK annuities broker, there seems to be a lot more going on here.
Yeah, absolutely. There's quite a bit beneath the surface. So I suppose our mission in this deep dive is to cut right through any, preconceptions you might have and
Yeah.
really understand what annuities actually are based on this info. Pulling out the surprising bits, the key takeaways relevant to you.
Okay.
At its heart, it's pretty simple. Taking a lump sum, often pension money, and turning it into a guaranteed income. For life, usually. Let's get into it.
Okay, so let's unpack this.
Yeah.
Based on the source, the core idea sounds straightforward enough. You give a pot of money to a provider,
Yeah.
and they promise to pay you an income for the rest of your life. Is that basically it?
That's the core of it. Yeah, it's that guarantee that's the key thing. You know exactly what income you're getting right from the start for as long as you live.
Okay.
And the source material, it really stresses this getting the best outcome. It really hinges on one critical step,
Which is?
shopping around. On the open market, you
Yeah.
absolutely have to compare providers.
Got it. And while we often think pensions, the source mentioned it doesn't have to be just pension money. Cash is okay too.
Yeah, cash works. Though there are usually minimums, you can't just throw in 50 quid.
Right.
The source mentioned about £2,000 minimum for pensions, but the popular pot values they see, often more like £50,000, maybe £100,000, that sort of range.
Okay, so digging into how they actually work,
Yeah.
this is where the source suggested it gets really interesting, maybe a bit counterintuitive.
Definitely. So the providers, they take your money and invest it. The source talks about UK midterm gilts, like 12 to 15-year government bonds. That's a common place for the money to go.
Okay, straightforward investing.
Well, yes, but that's only part of the story for how they fund that guaranteed income. A really significant part actually comes from pooling risk.
Pooling risk.
Or-
Yeah, the source is pretty blunt here. They actually called it a bet against people die.
Exactly. It sounds a bit harsh, doesn't it? But it's fundamentally about something called mortality pooling.
Okay.
The provider is essentially making a large-scale calculation, a bet if you like, on the average life expectancy across a whole group of people taking out annuities.
Right.
So when some individuals in that group, unfortunately, pass away earlier than that average, the pricing was based on the money that would have gone to them. It helps fund the income for those who live longer.
Ah, I see. And that's the mechanism that lets them pay out an income rate that's actually higher than you'd get just from the underlying investments, like those gilts.
Precisely. That's where the extra percentage points come from, essentially. The source points out, if gilts are yielding around, say, 4.9%, that mortality pooling is what allows them to offer an income rate maybe closer to 7.7%.
Okay, 7.7%. So show me the money then. What does that look like in, pounds and pence for someone?
Sure. The source gives a pretty clear example. A 65-year-old, let's say, with a £100,000 pension pot,
Okay.
they could realistically expect a starting income of around $7,700 a year.
Wow. Okay. That's that 7.7% income rate you mentioned. And the source highlighted that's quite high compared to, say, the usual 4% withdrawal rule people talk about for investment pots.
Yeah, it is noticeably higher than that common benchmark. But there's a catch, or rather, a choice to make.
Good one.
That £7,700 example, that's typically for an income that stays level the same amount every single year.
Okay. Static.
Right. If you want that income to increase over time, maybe to keep up with inflation, or by a fixed amount like 3% a year, well, your starting income will be lower.
Ah, makes sense.
For that same £100,000 pot, same 65-year-old, but with a 3% annual increase built in, the source says you're probably looking at a starting income more like £5,700.
Right. So that immediately presents a trade-off for you, the listener. Do you go for the higher income now or protect its value for the future?
Exactly. It's a key decision. Immediate needs versus future-proofing against rising costs.
And it's worth remembering, as the source pointed out, these current rates, like that 7.7%, they're significantly higher than they were just a few years back.
Oh, massively. Around 2020, that same £100 K pot for a 65-year-old, you'd have been looking at maybe closer to 5%, maybe even a bit less.
Wow.
So the rise in interest rates and gilt yields since then, it's really brought annuities back into the conversation, made them much more popular, potentially more valuable again.
Okay, now here's another really interesting angle. Maybe the most counterintuitive thing from the source material.
Mm.
How your individual health and lifestyle actually affect the rate you get massively.
Yeah, it's fascinating, isn't it? It's the complete opposite conversation you'd have if you were trying to buy life insurance.
Yeah, with life insurance, you're trying to prove you're super healthy to get a low premium, but with what they call an enhanced annuity.
You actually want to declare things. Anything that might suggest, from the provider's statistical viewpoint, a potentially shorter life expectancy.
And the source gave some pretty vivid examples here. They look at specific health conditions, your BMI,
Yeah.
even things like your job and where you live, your postcode.
Mm-hmm.
Smoking, for instance.
Mm.
Apparently, if you smoke, say, 10 cigarettes a day, that alone could boost your base annuity rate by roughly 15%.
It sounds bizarre, but in this very specific financial context, there's a sense in which, as the source puts it, it almost pays to smoke or have certain health conditions.
Do they check? I mean, can you just say you smoke 20 a day?
Yeah, good question. Yes, according to the source, they do check. They mention sometimes contacting your GP, maybe in about 1 in 3 cases, they said.
Okay.
And they might do things like nicotine tests. There's actually a funny anecdote in the source about a husband who'd initially got quotes saying he was a non-smoker, but his wife wasn't there. When the actual paperwork arrived, he apparently had to sheepishly call back and confess he did still smoke because he knew they might check up on it.
Huh. Okay, so honesty is the best policy, even if it feels weird, listing your ailments.
Pretty much. And the source made the point that even seemingly minor things can add up.
Like what?
Well, being slightly overweight, perhaps, or maybe taking preventative medication for something like high cholesterol. Those things feed into their underwriting score and can genuinely contribute to getting you a higher guaranteed income for the rest of your life.
So the big insight here for you, the listener, is that those initial ballpark quotes you might see online, they're just a very rough guide.
Exactly. Your specific health, your lifestyle, those details are incredibly important and can make a really significant difference to the final income you're actually offered.
Okay, let's maybe step back a bit and look at the history here. The source went into the period before the big pension freedoms that George Osborne introduced back in, 2014, coming into effect 2015?
That's right. Before then, the landscape was totally different. The vast majority, the source said over 90% of people with what are called defined contribution pension pots.
Oh, just quickly for the listener, defined contribution or DC pots, that's the type where you and maybe your employer pay in, and it grows kind of like a personal savings pot for retirement, depending on investments.
Correct. Versus defined benefit or DB schemes, the older style, often final salary schemes where the employer promises a specific income based on your salary and how long you work there.
Got it. So before freedoms, people with those DC pots, the savings style ones, were mostly forced to buy an annuity.
Largely, yes. They were effectively funneled into buying an annuity with their pot at retirement.
And the sources take on the change, the freedoms, generally positive.
From their perspective, yes, it was seen as a good decision overall. Because forcing everyone into one specific product, particularly when annuity rates were historically quite low, it just didn't seem right.
Yeah.
The intention was really to give people more control, more choice over their own retirement savings.
But the source also presented the other side of that coin, didn't it?
It did. While it was good for individual choice, the change also, let's be frank, significantly benefited the Treasury.
That's so.
Because people suddenly started accessing their pension pots much more freely, often taking large chunks out, which meant more income tax revenue coming in.
Right.
And it does raise that question the source sort of hinted at. Did it maybe give people too much control? Or perhaps control without enough guidance or understanding of the implications?
They used that slightly crazy example of someone apparently taking their pension money and buying a parking space in Dubai.
Exactly. Which, highlights the risks people now face. Taking big lump sums can easily push you into higher tax brackets unexpectedly.
Yeah, that 40% or 45% tax rate hits hard.
It does. And then there's the perhaps bigger risk of just mismanaging a large sum of money over decades, or simply outliving your savings if you spend too quickly early on.
Which brings us back to why some people still really like the idea of an annuity, despite the freedoms.
Absolutely. For many, that security, that guaranteed income you can't outlive, it's just incredibly appealing. It provides peace of mind. It's, as the source put it, done and sorted.
Okay. Now, you mentioned earlier, annuities aren't just one single product. The force detailed different flavors, different options.
Yes, and this is really important for you to understand because it's not a simple yes-no decision. There are variations. First up, you have the standard lifetime annuity. That's the one paying income for as long as you live.
The baseline model.
Kind of, yeah. But even within that lifetime model, there are several key options you can often add.
Such as?
Well, there's the joint life option. This means a percentage of your income, and you can usually choose anywhere from 1% right up to 100%. Keeps getting paid to your spouse or registered civil partner after you pass away.
Okay, but that presumably costs more, as in your starting income is lower.
Correct. Providing income for potentially 2 lives costs the provider more, so the initial rate for a joint life annuity will be lower than for a single life one.
Makes sense. What else?
Then there's something called value protection. This basically ensures that if you die relatively early before you've received back in income, at least the amount you initially paid for the annuity,
Right.
the difference, the remaining capital value, is paid out as a lump sum to your beneficiaries or your estate.
Okay, like a money-back guarantee if you die early. That also costs extra, I assume.
It does, yes. It reduces your starting income compared to not having it.
And the most popular option the source mentioned, something about a guarantee period.
Yes, the guarantee period. This is quite common. It guarantees that the income will be paid out for a minimum fixed period, say 5, 10, 15 years, maybe even up to 30 years, regardless of whether you live that long or not.
So, if you took a 10-year guarantee and died after 6 years,
The income payments would continue to your beneficiaries for the remaining 4 years of that guarantee period.
and a source said this one is popular and relatively inexpensive.
Yeah, compared to some other options like 100% joint life or full value protection, adding a guarantee period, especially a shorter one like 5 or 10 years, often doesn't reduce the starting income by a huge amount. They gave an example, I think, of a 15-year guarantee at age 65, still getting a decent rate, effectively guaranteeing over 109K back over that time, whether you lived 5 years or 20.
Interesting. Okay, shifting slightly.
Yeah.
There was another type of annuity the expert and source seemed to quite like, fixed term.
Yes, fixed-term annuities. These are quite different from the lifetime ones we've just discussed.
How so?
They don't pay income for your entire life. Instead, as the name suggests, they run for a fixed duration. Could be anything from, say, 3 years up to maybe 25 years.
Wow.
During that fixed term, you get a guaranteed income, just like with a lifetime annuity. But, and this is the crucial difference, they also guarantee that a specific amount of your initial capital is returned to you as a lump sum at the end of the term.
Ah, okay. So you get income and some money back at the end.
Exactly. Taking that £100K example again, a 5-year fixed-term annuity might pay you, say, £8,000 a year for those 5 years and guarantee to return something like £82,000 or more at the end of the 5 years.
So 40K income plus 82K back. That's over 122K total return on 100 K over just 5 years.
Something like that, yeah, based on current rates mentioned.
Yeah.
It offers income security for a set period, but crucially gives you flexibility because you get that chunk of capital back. You can then reinvest it, buy another annuity, whatever you want.
Can you get out of them early if you need to?
Potentially, yes. The source mentioned you can often cash them in, although the value would be recalculated based on market conditions at the time, so it might be less than you hoped.
And a key use for these fixed-term ones, the source highlighted, was as a kind of bridging pension.
That's a really common use case. It can provide you with a guaranteed income for maybe, say, 3 or 5 years, allowing you to retire earlier or perhaps reduce your working hours.
Right.
While you wait for another pension, like your state pension or maybe a defined benefit scheme from a previous job to kick in at age 66, 67 or whatever. It bridges the gap.
Makes a lot of sense. Okay, one more type the source mentioned briefly. Deferred annuities. Buying income for the future.
Yeah, this is an interesting concept, though maybe less common right now. The idea is you use some money today to purchase an annuity contract, but the income payments don't actually start until a much later date that you choose, perhaps age 80 or 85.
And logic there is.
Well, annuity rates are generally higher the older you are when you buy them because statistically your remaining life expectancy is shorter.
Right, back to that mortality thing.
Exactly. So the thinking is you could potentially lock in a very high level of guaranteed income for your very late life, maybe securing funds for potential care costs, and crucially, mitigating that risk of running out of your own money when you might be frail or less able to manage finances.
But as the source pointed out, that sounds like quite a gamble itself.
It is. You're locking into a plan potentially decades in advance. You have no idea what annuity rates will actually look like then, or what your health will be, or even if you live that long. So yeah, it's a definite trade-off.
Okay, this raises a really important practical question for you, the listener. If you buy an annuity, especially a lifetime one that could pay out for 20, 30 years, What happens if the company you bought it from, the provider, goes bust? Is your income safe?
That's a crucial question, and the source addressed it directly. The good news is there's protection in place via the Financial Services Compensation Scheme, the FSCS.
The FSCS. Okay, how does that work for annuities?
They clarified the protection levels, which is
Yeah.
important. For a lifetime annuity, the pure income stream 1.100% of the income you were promised is protected by the FSCS. It doesn't matter how big your original pot was, the income itself is fully protected if the provider fails.
100% of the income.
Okay.
That's reassuring. What about those other types, like the fixed-term ones with the lump sum back or value protection?
Right. For annuity products that have a guaranteed lump sum return element, like the capital back from a fixed term annuity or a value protection payout, that specific lump sum portion falls under the standard FSCS limit for deposits and investments.
Which is currently £85,000 per person per firm.
Correct. So the income part is 100% protected, but any lump sum element is protected up to that 85K limit.
Okay, that's a key distinction. Did the source say provider failures are common?
No, the expert in the source did add that in their experience, it's actually very rare for these annuity providers to go bust. They tend to be very large, well-established insurance companies, but the protection is there just in case.
Good to know. Okay, moving on to costs. How much does buying an annuity actually cost you? The source said it's a bit different from investment fees.
Yeah, unlike, say, drawdown investments where you typically pay an ongoing annual percentage fee for platform and fund management.
Right.
Annuity costs are generally just baked into the rate you're quoted. It's factored into the income amount they offer you. You don't usually see a separate annual fee listed anywhere.
So no ongoing charges. But there is a cost somewhere.
The main cost you need to be aware of, according to the source, especially if you use an intermediary, is any broker fee or advice fee.
Ah, okay. How does that work?
It's usually calculated as a percentage of the money you're actually using to buy the annuity. So a percentage of your 100-count K-pot, for example.
And the source gave a warning here, a kind of red flag number.
They did. They suggested that you should probably expect a fee somewhere in the range of 1% to maybe 3% for this kind of service, finding the best right handling the paperwork.
Okay, 1 to 3%.
But if you see a fee being quoted that's 5% or even more of your purchase price, the source said that should be a definite red light.
Right. Time to ask some serious questions.
Exactly. You need to be very clear on what extra service or value you're getting for that significantly higher amount. They also explained the fee either comes directly off the capital you're using before the annuity is bought, or it's sometimes structured to subtly reduce the annual income rate you receive over the lifetime of the annuity.
But the net effect on your income is the same either way.
Pretty much, yes. It's a cost that impacts your overall return.
Okay, so given the potential differences in the underlying rates between providers and the impact of these potential fees, this leads us back to a really crucial takeaway from the source, doesn't it?
Absolutely. You have to shop around. It is vital to compare quotes to make sure you're getting the best possible deal for your specific circumstances.
And the source provided a really, frankly, startling statistic on this.
It was quite eye-opening, yeah. They said that for the exact same person, same age, same health details, looking for the exact same annuity features, there is, on average, a 15% difference in the annual income offered between the provider giving the lowest rate and the one giving the highest rate on the open market.
Wow, 15%. That's a huge difference in your retirement income, potentially for decades.
It really is. Yet, despite that, the source also mentioned that, surprisingly, around 40% of people still just accept the annuity, quote, offered by their existing pension provider when they retire.
Just out of inertia, presumably. Or maybe not realizing they can shop around.
Probably a bit of both. Inertia, maybe thinking it's easier, or just not being aware of the potential gains from looking across the whole market.
So where do you shop around? How do you compare?
Well, the source points towards using specialist annuity brokers. They mentioned Retirement Line, the company their expert worked for, as an example, because brokers have access to compare rates from all or most of the providers in the market simultaneously.
Oh, brokers. Anywhere else?
You can also use free online resources. Money Helper, the government-backed guidance service, and PensionWise, they have tools where you can get illustrative quotes online.
But you can't actually buy an annuity through those government sites.
No, they're informational tools. They help you understand the possibilities. But to actually transact, you typically go direct to a provider after comparing, or use a broker. The key message was getting free quotes, whether via a broker or online tools, is a powerful first step to see what income you might get.
And the source also sort of emphasized the value a broker can bring beyond just finding the best rate.
Yeah, they made the point that while the underlying annuity products themselves are fairly similar across providers, a good broker adds value by making sure you fully understood all the different options, joint life guarantees, inflation linking, etc.
Right.
And critically, ensuring that you've accurately provided all that health and lifestyle information we talked about earlier. Because getting that right, as we heard, can genuinely boost your income significantly, and a broker can help guide you through that disclosure process properly.
Okay, so annuities, historically, they did have a bit of a bad reputation, didn't they?
They really did.
Why exactly was that? The source unpacked the reasons.
They pointed to a few key factors, really. For a long period, especially in the run-up to the pension freedoms, annuity rates were just, well, poor, objectively low.
Because interest rates generally were lower.
Exactly. Low interest rates, low gilt yields, it directly translated into low annuity payouts. Then, as we discussed, before the freedoms, people often felt they were being forced into buying one, whether they liked the rate or not.
Yeah, lack of choice.
And thirdly, compared to the idea of keeping your money invested in drawdown, where you retain control and flexibility, annuities felt very rigid. You hand over your lump sum, and that's basically it. You couldn't change your mind.
Right, locked in.
So low rates, compulsion, inflexibility, that was the bad rap.
But the source argues there are now compelling reasons to maybe reconsider them.
Absolutely. The landscape has changed. Primarily, it's those current higher rates we've talked about, that 7.7% example compared to the old 5% or less, or even against the standard 4% drawdown rule.
It looks much more attractive now.
It does. And secondly, in today's more uncertain economic times, that element of certainty that an annuity provides, knowing exactly what income you'll get, guaranteed for life, that holds a lot more appeal for many people than it perhaps did a few years ago. They're seeing a resurgence in popularity because of this combination.
Okay, shifting into strategy now. What seemed fascinating from the source was how people are now thinking about using annuities. It's not necessarily an all-or-nothing decision anymore.
No, definitely not. That's a really key shift. The source discussed the strategy of partial annuitization.
Partial annuitization,
And-
meaning
Meaning you use just a portion of your total pension savings to buy an annuity rather than the whole lot.
and the goal there.
Typically, the goal is to use that annuity portion to generate enough guaranteed income to cover your essential baseline living costs for the rest of your life.
Yeah,
Your bills, food, basic needs.
like a safety net income.
Exactly. They gave an example, I think, of maybe using just a 20,000-pound pot to buy an annuity. That income, when added to your state pension, and perhaps with some income escalation built in, might be enough to cover the official minimum retirement living standard.
Okay, and the rest of your pension pot.
The rest can then stay invested in drawdown. That gives you flexibility, allows you to potentially benefit from investment growth, and you can dip into it for discretionary spending, holidays, emergencies, whatever. It's blending security with flexibility.
That makes a lot of sense. They also touched on potential future changes like inheritance tax rules, something about 2027.
Yeah, there's some ongoing uncertainty about how pensions will be treated for inheritance tax in the longer term, with maybe some clarification expected around 2027. Depending on what happens, the source suggested it could potentially make accessing pension money earlier, or perhaps using annuities to secure income while passing other assets on, a more attractive option from a tax planning viewpoint for some. But that's quite speculative right now.
Okay, looking even further ahead, the source mentioned a possible industry trend, a sort of default pathway emerging.
Potentially, yes. They suggested the pensions industry might be moving towards recommending or even defaulting people into a pathway that involves using drawdown for, say, the first 10 years or so of retirement,
Right, for flexibility early on.
followed by automatically converting some or all of the remaining pot into an annuity later in life, maybe from age 75 or 80 onwards.
Interesting. And the thinking behind that kind of default switch.
It's really about managing longevity, the risk of people running out of money in very old age.
Oh, okay.
Especially as people get older, they might face cognitive decline, making it harder to manage complex drawdown investments effectively. So automatically switching to a simple, guaranteed annuity income later on could provide security when it's most needed.
That's quite a shift in thinking. Another factor they mentioned was the pensions dashboard.
Yes, the Pensions Dashboard Initiative, which aims to let you see all your different pension pots from various jobs all at one place online.
How does that relate to annuities?
Well, the source's point was that currently people often think of their pensions as small, separate pots from different employers. But
Mhm.
when you see them all aggregated together on the dashboard,
It might look like a much larger sum.
exactly, suddenly that 15K pot here and 20K pot there adds up to maybe 100K or 200 pound K total. Seeing that larger figure is likely to shift people's mindset towards more strategic, long-term planning for the whole amount.
And that might include considering using part of it for an annuity.
Potentially, yes. It encourages thinking about the bigger picture of retirement income, where annuities can play a role alongside drawdown.
And they also noted that average pot sizes are just getting bigger anyway.
Significantly so, according to their figures. They mention average defined contribution fund values at retirement were maybe around 70,000 pounds pre-2020, but more recently they're seeing averages over 125,000 pounds.
Wow, quite a jump.
Yeah. And this means more people, including those you might consider higher net worth individuals, are now looking at using partial annuities, using maybe 100 pound or 200 pound out of a larger 500 pound K plus pot to lock in a guaranteed income foundation while keeping the rest invested.
So using annuities as one tool in the retirement toolkit, not the whole solution.
Precisely. And just to reiterate a key point they made, you don't have to make one single annuity decision for life.
Oh, right, you can buy more later.
Absolutely. You could buy a small annuity now, maybe another one in 5 years. If rates change or your circumstances evolve, you can layer them over time.
Okay, so wrapping this all up, what does it mean for you, the listener? It feels like annuities might be, well, a lot more interesting and maybe more valuable than they first appear, especially right now.
I think that's fair to say. The current rates certainly make them more competitive than they have been for years.
And the source material really hammered home two things for me. The absolute necessity of shopping around on the open market
Crucial. That 15% average difference is huge.
and understanding just how much impact your personal health and lifestyle details can have on the actual income you could get.
Yes, that enhanced annuity angle is fascinating and potentially very rewarding if you have health issues.
So connecting that back directly to you, the listener, why should you bother getting an annuity quote, even if you're not sure you want one?
Well, beyond just seeing the potential income, there's an interesting informational aspect the source touched on. Getting a quote that's properly underwritten for your specific health, it's essentially getting a prediction.
A prediction.
A prediction from major financial institutions based on all their actuarial data about how long they think you are likely to live.
Wow. So it's more than just a financial quote. It's like,
It's like getting your own personal data-driven longevity estimate.
yeah.
The expert in the source even playfully called it your own death clock prediction.
Maybe slightly more reliable than a palm reader, perhaps.
Hopefully a bit more grounded in data, but it creates this slightly strange counterintuitive dynamic, doesn't it? Where, in a way, if you buy an annuity and then live longer than their statistical models assumed for you, you're kind of winning against the house.
You're beating their prediction.
Exactly.
Okay. And to leave you, the listener, with one final thought to maybe mull over, drawing inspiration from the source material.
Go on.
Consider the future. What about potential major medical breakthroughs? Or advances in AI that could radically change life expectancy predictions in the coming years or decades?
An interesting thought.
If significant increases in healthy lifespan are genuinely on the horizon, does the decision to potentially lock in an annuity now, based on today's data and assumptions about mortality, does that make it an even more intriguing gamble, securing income based on a potentially soon-to-be outdated lifespan prediction?
That's definitely something for you to think about. A fascinating intersection of finance, health, and future possibilities.